All right, here we go. All right, thank you all. And without further ado, this is Chad. Could you jump in and
Sure.
start?
Yeah. Thanks, Ann. Well, good afternoon, everyone. My name is Chad DeGrasser. I'm a partner with DGC, so I co-lead our architecture and engineering practice. And so happy to be with you today to share some updates on the PPP loan forgiveness. Just by way of background, so the slides that we're going to go through, I put those together last night. I was trying to wait till the last minute because we knew that there would be some guidance coming out, and as luck would have it, the guidance came out this morning. So these slides are outdated, and I will do my best to try to go over what the guidance that was released today actually says. But I would certainly highly recommend that everybody check out the Treasury's website, talk to your CPAs, because this is sort of right off the press. And so I haven't really had a chance to fully digest everything that's in the guidance that was released today. But we'll try to cover the key points and let you know where I think things will land and the areas that are still open for clarification. So you can go to the next slide, Ann. So this was just going to say we're waiting for the guidance, but it has come. So we do have some clarity now. There we go. So in terms of what we'll cover today, I know there's been a lot of questions around the covered period. Is it 8 weeks? Is it 24 weeks? Is it something in between? So we do have some clarification there. So we'll go over the covered period, the loan maturity dates, the payment deferral period. So if you do not get a portion of your loan forgiven, when would you have to start paying that back? We'll go through the payroll versus non-payroll split. So it used to be 75-25. It's changed to 60-40. But as you'll see, there is potentially something that you need to be aware of with a 60% cliff for payroll. So I'll talk about that. For those of you that have had to make some difficult decisions around staffing and salaries, there are some abilities to bring those or restore those salaries or that headcount and not have it impact your forgiveness. So I'll talk about that. Also, within the recently passed legislation, they did now allow companies that pursue the PPP loan and forgiveness. You also now have the eligibility to defer your FICA taxes, so the employer portion of FICA taxes for the rest of this year. So I'll talk about that. And then finally, just talk about the taxability of the forgiveness amounts as we're calling it. And then, as Ann said, we'll try to get to as many of your questions as we can. So if you go to the next slide, Ann. All right, so in terms of the covered period, many of you may have heard that in the recent legislation, they expanded the covered period to 24 weeks. And so what we do know now and what has been confirmed in the guidance that was released today, excuse me, is that it is a binary choice. So it's either 8 weeks or 24 weeks. You cannot pick a time period in between. And you can only elect the 8-week time period if your loan was approved before June 5th. If your loan was approved on or after June 5th, your covered period is the 24 weeks. But again, if your loan was approved before June 5th, so effectively you got the money before June 5th, you can elect either the 8-week or the 24-week covered period. If you find in going through your calculations that you cannot spend all of the money within the 8 weeks and you're debating whether to go for the 24-week covered period, you just have to keep in mind that all of those tests for head count and salary dilution need to be performed over the full 24 weeks. So if you were, let's say, in a situation where you would spend all the money in week 12 by week 12, and then you would, contemplating making some decisions around salary reductions, headcount reductions in, let's say, week 16. Those potentially could impact your forgiveness amount because you do have to go through the full 24-week period to perform those calculations. So I'll touch on that in a little bit more detail in a future slide, but did want to point that out. The next thing that I just wanted to clarify is there is this option called the alternative covered period for payroll costs. And so this alternative covered period does not apply to your rent, your mortgage interest, or your utilities. It only applies to the payroll costs. And by payroll costs, that's a very wide umbrella because it does include health insurance, retirement, state and local taxes. For companies that pay bi-weekly or more frequently, so if you pay semi-monthly, you're not able to choose this alternative covered period. But again, if you pay bi-weekly or more frequently, so weekly, you can elect to have the period start on the first day of the first payroll period that starts after you got the money. So essentially, if you don't do that, you may have to prorate the first salary amount. And if you go to the next slide, Ann, I think this graphic will help. So let's assume you do not choose the alternative payroll covered period. And this just assumes an 8-week covered period. You got your loan on April 17th. The first payroll that you paid was on May 1st, but that payroll period included May 15th to, just for purposes of this, let's just say May 1st. Because you got the money on the 17th, and let's just assume these are all working days for purposes of this example, you theoretically cannot include payroll for the 15th or the 16th because those were incurred before you got the money and before your covered period starts. So on the 5/1 payroll that you run, for purposes of the forgiveness calculation and what you can include as the use of the funds, you would have to prorate that payroll and carve off those first 2 days, and you would not be able to include them. The SBA and the Treasury realized that would really just create an administrative burden for a lot of firms and unnecessarily complicate the process. And so that's why they allowed this alternative covered period, which essentially means you can pick May 2nd as the date that your alternative covered period would start for your payroll. So by choosing May 2nd, obviously that's the first day of the payroll cycle. It's all paid within the covered period. You don't have to prorate that first payroll. You can actually start the clock on May 2nd. And so for purposes of payroll, the time period you would use would start on May 2nd, not April 17th when you actually got the money. So that, again, it's an option. You don't have to use the alternative covered period, but it may simplify your calculation. The other point there is that for the very last payroll, so in this example, let's say that the pay period, it actually, let's just say it ends on the 15th, you actually pay it on the 15th, so you're outside of the 8-week window. That's okay. They've clarified that payroll costs that are incurred, so only the time through the 12th in this example would count. But even though you don't pay for that time until the 15th, that's okay. As long as the payroll is paid on or before the next regular payroll date, you can include it. And the reason that I'm spending some time here is because the Act says that for payroll to be counted, it has to be incurred and paid within the covered period or the alternative covered period. But they made this exception where you don't actually have to pay that last payroll in the covered period. They give you to that next date to pay it. But again, you can only include up to June 12th. So you still would have to carve off the 13th, 14th, and 15th of June and not include those because they're outside of the covered period window. So hopefully that was clear, but if you have questions, we can go through that at the end. Next slide, Ann. So in terms of the maturity dates of these loans, so the loans approved before June 5th have a 2-year maturity. So to the extent that some of your loan is not forgiven and you want to keep it as a loan, you basically, these loans will have a 2-year maturity. If your loan was approved on or after June 5th, it has a 5-year maturity. Now, what they also said is that the lender, for those loans that were approved before June 5th, the lender can work with you and actually extend that maturity date to 5 years. However, they have the option to change the terms. So they could change the interest rate, they could change the guarantees if you do that. For those loans that were approved on or after June 5th, there is no flexibility from the lender. It is a 5-year maturity. It's a 1% interest rate. There's no personal guarantees. And you have that with the 2-year maturity if your loan was approved before June 5th. But if you seek to extend those terms, just be aware that the lender may change those terms. And so you just want to make sure you understand that before you sign off. This is one of the areas where I haven't had a chance to fully go through all of the guidance that was issued today, but what was issued previously said that the forgiveness application is due within 10 months after the end of the loan forgiveness period. So that's a long time between the end of the forgiveness period and when the application is due. So I don't know if they've changed that or updated that. That was in the guidance that existed before this most recent guidance came out. But I think the takeaway here is I would certainly talk to your bank if you're getting close to your the end of your covered period and just ask them when they are expecting you to provide the documentation if you're choosing to stay with the 8-week period. Obviously, if you're choosing the 24-week period, then you've got more time. So again, I would make sure you're talking to your lender. In terms of the payments for the loan, if there is a piece that is not forgiven and you decide to keep the loan, the payments are deferred until the forgiveness amount is approved by the SBA. And so just to give you a timeline of how that approval process will work, once you submit your forgiveness application, the banks have 60 days to review it. At that point, they then send the files to the SBA. The SBA then has 90 days to review the bank's determination and issue a final judgment on the forgiveness amount. So, essentially 5 months between when you submit your forgiveness application and ultimately when you could hear the final determination. So that's would determine when your payments would be due. Again, if some of the loan is not forgiven and you choose to retain the funds and not simply pay them all back. Next slide, Ann. So here was a real significant change that was made in the forgiveness calculation. So before, there was a requirement to spend 75% of the loan proceeds on payroll costs. The other 25% could be spent on rent, utilities, mortgage interest. They've now changed that. So to maximize the forgiveness, at least 60% has to be spent on payroll, health insurance, retirement, state and local taxes. 40% can be spent on rent, utilities, and mortgage interest. However, here is an area where you really need to look at if you think that you will not spend at least 60% of your proceeds on payroll. And I would really make sure here that you're talking to your CPA. The way that it's written is that if you do not spend 60% on payroll, let's say you spend 59%, there's a question whether any of it is eligible for forgiveness. So that's what we meant by a cliff. If you don't get to 60% of payroll, you may not have any of it forgiven. I took a look at the most recent guidance that was issued today, and that language still does look like it's in there, that you have to spend at least 60%, but I haven't had a chance to go through all of the guidance, so it may be there, and I just haven't had a chance to go through it. So that's certainly an area. If you don't think you're going to hit 60%, make sure you're reviewing those calculations with your CPA. If you know you're going to be above 60% on payroll, then this is really a non-issue for you, and hopefully gives you a little bit more room to include, whether it's rent, utilities, things like that. Next slide, Ann. So I thought what we could quickly do is just remind everybody what the allowable uses are of the covered loans. And so this applies during the forgiveness period, but it also applies after the forgiveness period. So if there's a portion of the loan that you're going to keep as a loan, you still can only use those funds for these approved areas, even though we're not talking about forgiveness. You still are limited in what you can use those proceeds for. So for employee payroll costs, and I say employee because I'm distinguishing between employees and owners. So for employees, there is a cap. Now, if you choose the 8 weeks, that cap is $15,385. If you choose the 24 weeks, that cap is $46,154. And that includes salaries, wages, it includes bonuses, vacation time, if there's been any, severance. And again, they just all have to be within those caps. Key point here is the employees have to be US based employees. So if you have any foreign employees, those do not get counted as part of these calculations. So all of those costs in that first section are subject to those caps down below. The next section of costs are above and beyond the cap. So if you stick with the 8 weeks, an employee caps out at $15,385 in terms of their salary. You can add on top of that healthcare benefits, again, the employer share of healthcare benefits, the employer share of 401k matches, profit sharing contributions, and the employer share of state and local taxes. No prepayments of salaries are allowed, so you can't prepay somebody's salary. But as long as you're within those caps, this is how it should work for employees. Next slide, Ann. It's a little different for owners. And I would basically say that you have to segregate owners into 3 different buckets based on the entity type. So are you an S corporation, a C corporation, or an LLC? If you're an LLC and your owner's in an LLC, that 15,385 cap is all in cap. That includes everything: health insurance, retirement, state unemployment. We think that that's an all in cap. And again, big asterisk. I haven't had a chance to go through all the guidance, so you want to make sure that you really understand that. They do specifically talk about self-employed individuals, i.e. LLC owners, S corporation owners, and C corporation owners in the guidance. So you just want to make sure you read through those provisions and just understand that there are some caps for owners that are not there for employees. LLC owners are in the worst position, unfortunately, as that has the most strict cap. S corporation owners, you cannot add the employer share of health. C corporation owners, we think you can, but there are some other caps that you have to look at. And so again, it's an area I just have not had time to look at. So just be aware that for owners, there are different caps. There's also some calculations that you have to look at, because for owners, you also have to look at what their income was in 2019. And that could be a secondary cap that you have to watch out for. So it does get a little bit more complicated for owners. Next slide, Ann. So in terms of rent costs, so office leases, we do think office parking spaces are also allowable. That's an area that I would certainly talk to your CPA on. Personal property leases, what do we mean by that? Company-owned autos, plotters, computers, things like that. If you have leases for any of that, those types of equipment, those can all be included in the rent bucket. Again, no prepayments are allowed. One of the questions that we're still, sort of wrestling with and trying to figure out is whether you can include any common area maintenance or real estate taxes that may be part of your lease. We don't know for sure. So that's an area that we certainly would recommend that you talk to your advisors about and make a determination on whether you want to include those or not. For utilities, and let me go back to the rent. It's really important that the agreement was signed with an effective date before February 15th of 2020. If you have a new lease that started after that date, you may not be able to include any of the costs related to that lease. So that February 15th date is important. And you'll see that really, I don't know that it matters as much for utilities, but same sort of thing. And what we mean by that is you have had to have, let's say, the telephone plan in place by February 15th. It can't be a brand new plan. So as long as the plan was pre-existing February 15th, you can include those costs. And so for utilities, that's electric, gas, and water, internet, office telephones. Question that's out there, cell phones, are those allowable? And we don't know. Some people are taking the position that they are, some are taking the position that they're not. So again, just something to be aware of, that we don't think the guidance is crystal clear on this. We're hoping that does get clarified. Again, no prepayments allowed for utilities or rent. So you only get the covered period amount, whether that's the 8 weeks or the 24 weeks. You're not allowed to do any prepayments. Next slide, Ann. So interest on mortgage obligations. So not the principal payments, but just the interest costs. Again, these debt arrangements had to have been in place before February 15th. So if you have a loan for a build out or any leasehold improvements, loans for computers, other type of equipment, all of that would be eligible. Again, no prepayments allowed. You cannot include interest on working capital loans, lines of credit, stockholder buyout loans. Those are not allowable uses of the money. Next slide, Ann. So what I just wanted to sort of highlight here is for those firms that during the covered period actually did have to reduce headcount or did have to reduce salaries and wages for certain individuals beyond 25%, there is a chance that you would not get all of your loan forgiven. And so what you see in the first column here again is the 60% requirement for payroll costs, the 40% for all the other costs. You then have to run that forgiveness amount. So that's the total amount that you spent over the covered period, either the 8 weeks or the 24 weeks. You then have to run those costs through two different tests, the FTE dilution test, so head count, and then the wage and salary dilution tests. Now, if you go through each of those tests and you do find that you have to reduce the forgiveness, you do have the option of restoring headcount and salary levels by December 31st, 2020, to then get your forgiveness back up to the full amount. So even if you did make some of those choices, there still is some opportunity to maximize the forgiveness. So we'll go through that now. And next slide. So again, obviously the goal is 100% forgiveness, can only include the allowed cost, at least 60% must be used for payroll. Next slide, Ann. So in the first test is the head count or the FTE dilution test. So FTEs, so they did clarify this is based on a 40-hour per week standard. So what you have to do for this test is you get to choose. You look back and you say, what was your average FTEs from February 15th, 2019 through June 30th, 2019? So that's one option. The other option is January 1st, 2020 to February 29th, 2020. You calculate your average FTEs based on a 40-hour per week standard, and you pick the lower of. So if the time period February to June gave you 30 FTEs, January to February gave you 35, you want to pick February to June 30. You want to pick the lower of, because that's the amount that you're going to compare to your covered period. So when you go through that calculation, again, you're just going to compare what are your FTEs from the base period, what are your FTEs during the covered period. If you're lower in the covered period than what your base period is, you could be subject to a reduction in your forgiveness. For this slide, the wage, salary, and dilution test. So this is for any employees that made less than $100,000 in 2019. So if you have your employees separated into buckets, you'll have one bucket where they made more than $100,000 in 2019. You do not have to look at those employees for purposes of this test. For the employees that made less than $100,000 in 2019, you have to look at this test. For that group, if you've reduced their pay from what it was in Q1 of 2020 by more than 25%, then you possibly are losing some of the forgiveness amount. If you've only reduced their pay by 10%, 15%, 20%, then you're okay. You're not going to be impacted by this test. But those are the key elements for this dilution test. Next slide, Ann. So as I mentioned, if you did have headcount reductions or salary reductions during the covered period, you have the option to restore those by December 31st, 2020. And if you restore those, you're able to get full forgiveness potentially. So again, you've got to work through the calculations, but you do have the potential ability of restoring what otherwise would have been lost in forgiveness because of those two tests. Next slide, Ann. There are some safe harbor provisions around, primarily around the headcount tests. So if an employee voluntarily terminates their employment, you do not have to include them as part of the headcount dilution test. However, you do need written documentation, and you also have to inform the state unemployment office that they voluntarily terminated. If an employee is terminated for cause, they will not impact your forgiveness calculation. If you laid somebody off and then offer to bring them back on and they reject the offer to return to full-time status, so let's say they were full-time, you furloughed them, or they were full-time and you brought them down to part-time, and then you offer to bring them back and they refuse, that will not impact your forgiveness calculation. However, again, you do need written documentation from the employee, and you have to inform the state unemployment office. Now, obviously, this can impact their ability to collect, but that is what you would need to do in order to use these safe harbor provisions. In addition, if because of COVID, you're unable to rehire terminated employees, bring everybody back because your specific situation is just that you can't do it because the impact that this has had on your business, you may be able to exclude some of those headcount reductions from the calculation. We still need some guidance in this area on what the documentation will be. And again, it may be there today. I just haven't had a chance to, I haven't had a chance to go through the documents to see if they have actually clarified that. The other piece that I would say, oh, can you just flip back 1 second, Ann? That's okay. The other way.
Ah, I know how to go back. All right, that's weird. Hang on a second.
There we go.
This one.
Yep, right there.
Sorry.
So one of the things that, again, it may be addressed in the guidance, and I just haven't had a chance to look at it. It's unclear whether, let's say that you got through your forgiveness period, then you laid somebody off, and you rehired them, but then you lay them off again. And so I'm just, going through a pretty extreme example. We just don't know, and again, it may be addressed in there, I just don't know whether you have to rehire and keep them on through December 31st, 2020 for purposes of these restoration calculations. So I think, the takeaway there is certainly, read through the guidance, talk to your CPA, your attorneys, to make sure that you understand how those provisions work before you make some decisions about bringing people back, just understanding what you may have to commit to in order to maximize the forgiveness. Okay, and then go next slide. So just a couple of other items here. So before the most recent legislation was passed, if you were applying for forgiveness, you could not defer the employer portion of FICA tax during the forgiveness period and then for the remainder of 2020. They've changed that rule. So now all PPP loan borrowers also have the ability to defer the employer portion of FICA tax for the remainder of 2020. So essentially that amounts to an interest-free loan. 50% of those taxes would be due on December 31st, 2021. The other 50% would be due on December 31st, 2022. Just remember that because you're not paying those taxes, you don't get a deduction for them. and this is a loan, you are going to have to pay that money back. But again, it's an interest-free loan. So from a working capital standpoint, if you know you're going to be into your lines of credit, this may be a really good alternative to at least reduce some of the borrowing, because you're going to reduce some interest costs. The other piece in terms of the taxability of the PPP loans, and there's been a lot of confusion around this. So what is clear is that the amount forgiven is not taxable. It is a tax-free grant. However, the way the Internal Revenue Code is currently written, expenses that are paid with PPP loan funds that are forgiven are not deductible. So effectively, the money is taxable. That's sort of the way to think about it. It is taxable. It's not really taxable, but you don't get to deduct the payroll, the rent. So in essence, it's the same thing. It is taxable. This, really was not the intent of Congress, but what we don't know is if they're going to change the tax code. So that's what we're waiting on. That would require a second act by Congress to change the tax code to do this. We just don't know if they're going to do that. So right now, we are advising clients to assume that you're not going to be able to deduct those costs as you're doing your year-end tax planning and things like that. Next slide, Ann. So just a couple of guidelines that I wanted to run through. And let me just skip ahead to the fourth bullet there. The audit period for these loans is 6 years after the loan is fully forgiven or fully repaid. So it's a long period of time. What the SBA and the Treasury have said is that if your loan amount is in excess is $2 million or more, you will be audited. If it's less than $2 million, you could be audited. Now, the chances are that your loan will be audited if you're under $2 million and significantly under $2 million. Probably not very high, but there is a chance that it could be audited. And so you want to make sure that you have in your records, you've documented why you needed the money. You've documented that you were eligible for the money, and you want to keep all of that and put it together now, because if they come back in 5 years, it's going to be really hard to remember all of the different things that you discussed, thought about as you were applying for these loans. So it's really important to get that documentation in place. And if you're over 2 million, it's an absolute necessity. You have to get that documentation in place. Obviously, make sure your funds were only used for eligible purposes. You really need to track the use of the funds very carefully. And again, just document everything as best you can. The good news that I've seen from some of the payroll companies is they're generating a lot of different reports going back to that FTE dilution test, the wage dilution test. A lot of the payroll companies are actually developing reports that are streamlining that calculation. They're actually doing the calculation for you, but I would make sure that you agree with that data. I wouldn't just take the data and assume that it's correct. So you do have to go through that data, make sure you agree with it, but they are, I think, very helpful in the reports that they are producing. So, and I think, whether it's ADP, Paychecks, Mass Pay, a lot of them are canned reports that you can just go in and download. And so I think that will really help you with these calculations. Obviously, monitor the SBA and Department of Treasury websites. As we mentioned, numerous times today, it just came out today. They're constantly updating the site with guidance. So you want to look at that. Timely application of forgiveness. Once you decide on the 8 weeks or the 24 weeks, you really want to get that application in, because as we said, it could take a long time to get the answer, and you want to have some clarity on whether your loan's been forgiven or not, and how that interplays with your tax planning for year end. So just a quick little plug. We're holding a separate webinar on June 22nd. If anybody's interested, you can just go to our website. Information is there. And by that time, we'll have digested, all of the recent guidance. This is not specifically for architects or engineers, so it's more broader. So just be aware of that. If you're looking for real industry specific, that's not the basis for that particular webinar. Next slide, Ann.
It's you.
That's me. Pre-COVID, before the just a little bit more hair than I have now.
All right, I'm going to close this.
So
Do you wanna
hopefully
go to
that
some
wasn't too
questions?
fast. Yeah, I thought it would be helpful now just to look at some of the applications that are up on the Treasury's website.
So I think this is the gut.
Yeah, this is the instruction. So what we've just saw today is that the Treasury and the SBA, they put out 2 different loan forgiveness applications and 2 different instructions. One is an EZ form. So essentially, if you look at this top line here, so you, the borrower, can apply for forgiveness using this EZ form if you can check at least one of the 3 boxes below. So first box, you're self-employed, so you're and you had no employees, so you're just a Schedule C self-employed owner, sole proprietor. You can use this EZ form. The second section, you did not reduce salary or wages of any employee by more than 25% during the covered period. So you didn't reduce salary, so you don't have to go through the test because you didn't do it. And you did not reduce the number of employees or the average paid hours between the covered period. So essentially what that's saying is, if you didn't reduce salaries, you didn't reduce headcount, and you're at least at the levels that you were in those base periods, you can use this EZ form. You don't have to go through in as much detail those other calculations because they just won't apply to you. You didn't do the salary reductions or the headcount reductions. The third bucket is, again, you did not reduce the annual salaries. And this is where, we still may need some more guidance. You were unable to hire people back or bring people back because of COVID and the restrictions that were placed on your business. I'm not sure that that's really going to apply to the A&E industry. I think that's more geared to restaurants, things like that just simply have not been able to reopen. So I'm not sure that this is going to apply, but it is there and certainly something to take a look at. If you scroll down a little bit more in. Yep, keep going. I think it's on the second page. Yes, right here. So covered period. So here's where it says the covered period is either the 24-week period or the 8 weeks if your loan was approved before June 5th. So that's where that's all coming from. The alternative payroll covered period right beneath that. So again, that talks about if you pay bi-weekly or more frequently, you don't have to carve up that first payroll if it sort of happens in between of when you got your money. You can start the clock for payroll purposes only with the first day of the first payroll period that happens after you got the money. Keep going down, Ann. So this is the amount, this is the section here, this forgiveness amount calculation, cash compensation. This is where it talks about employees, but then starts to bring in some of those limitations for the owners. So if you can see on employee benefits number 1, employer contributions of employee health insurance, Do not add employer health insurance contributions for self-employed individuals, general partners, so think LLC owners, or owner employees of an S corporation, because such payments are already included in their comp. So that's where the additional limitations are coming in, if you're an S corporation owner. They don't mention C corp in that bucket 1. So that would lead you to believe you can include the health insurance for C corp owners. But again, we need to go through the guidance and make sure it's not buried somewhere else. Number 2, so the 401k match, profit sharing, again, do not add that amount for any self-employed or general partner. Again, think LLC owner. And then it says, and contributions on behalf of owner employees are capped at 2.5 months worth of the 2019 contribution amount. So it's not saying that you can't include it for S corps or C corp owners, but you have to look back at what 2019 contribution was to see what can be included. And there's probably a lot more there that you have to go through, but again, just to alert you to that. Then we come down to a bucket that I didn't address in detail in the presentation, but owner compensation. So if you choose the 24-week window, remember you get $46,154 for your employees, but this says for owners, you only get a maximum of $20,833. Now, we don't know if this is just LLC, or I should say, I don't know right now. Is this just LLC owners? Is it S Corp, C Corp? So this is an area that we definitely have to read through to make sure we truly understand what the compensation is for owners. But the takeaway here is just be aware that there may be a further limitation for the owners that you have to incorporate into your forgiveness amounts. Can scroll down. Oh, go ahead.
So basically it's saying that even if you elect the longer period, owner compensation may be limited.
Correct.
Right?
It's still higher than the 15,385, but
it's not the full,
not the 40, right? Correct. But again, they only list LLC owners in that bucket, so we don't know if I don't know if S corporation owners, C corps are included in that limitation. That's something that I have to read through the full guidance to see if it clarifies that.
Yeah.
I think if Anne, if you've got some questions, we can probably maybe start to take some questions and then go through some of the other documents on the Treasury website if we've got time after that.
Okay. So let's see.
Anne, do you want me to jump in with them?
Yeah, if you're,
Okay.
that'd be good.
Okay, so the first one, Chad, was what taxes can be included in the payroll costs?
So the taxes that can be included are the employer share of state and local taxes that are assessed on employee wages. So think unemployment, state unemployment taxes. They're usually pretty small, and most employees have hit close to the cap during the first quarter of the year. So there's not a lot there, generally speaking. But if you think state unemployment, state disability taxes, the expanded medical leave, the employer portion of those state and local taxes can be included. Not FICA, not Medicare, only those state and local taxes.
Okay. The next question, and this came back, I think, to the principal place of residence having to be in the U.S., but what about an employee who can't return to the U.S. but is working remotely?
That's a great question. I don't know the answer to that. if they are a U.S. citizen and they are filing U.S. taxes, I would think you can, but I would just put a very big caveat around that. I think that's a question that you really need to talk to your CPA and legal counsel for. I apologize. I just don't know.
Okay. The next one came up. We were talking about the owner restrictions, and somebody asked, what about, are there any restrictions for LLP owners?
LLPs are the same as LLCs. And so, yes, there are restrictions, and they're the most stringent, unfortunately. So it's an all-in bucket for the LLP owners.
Okay.
Unless, and I should clarify this, and I should have clarified this sooner, unless you have made the election to be taxed as a corporation, either a C Corp or an S Corp. So if you're an LLC, you have the ability for tax purposes to be taxed as a corporation. In that situation, you would be receiving W-2 income, normal wages and withholdings. But if you're a partner getting draws, then unfortunately there are some pretty stringent caps.
Okay. All right. And then if you feel that you may restore employees by 12/31/2020, should you wait to file your forgiveness application until after 12/31?
Well, I would say that that's a great question. I think you have to go through the analysis. I'm assuming that individual question is somebody that has already decided the 8-week window is not going to work for them, and they're going to look at the 24-week window and sort of assess that. And maybe that person can respond in the chat if that's not correct. But if you're close, if you're going to stay with the 8-week window, or you're debating, do you stay with the 8-week or go with the 24, and you're trying to decide this point, unless your bank tells you differently, I think you can wait to file the forgiveness application even, long after the 8-week period has started, but still submit the application saying you want to use the 8-week period if it looks like you're going to make some decisions that are going to impact forgiveness negatively. I don't think you have to submit that application right after the 8 weeks is up. So you'll actually have time to sort of assess, whether the 8-week or the 24 makes sense, and it will give you some time. But there's a lot of different things that I think go into that decision. So, I would say that I think you have some time, but I would certainly work closely with your CPA to just run through some scenarios.
Okay. The next question, if an owner earned over $100,000 in 2019 and a salary reduction was taken after they reached that 15,365 max, would that reduction impact the forgiveness calculation, or would it be a moot point because they were over that $100,000 threshold?
Yeah, for the owners, as long as it's a great question, but if they were over $100,000 in 2019, and Tracy, correct me if I'm wrong, they were at 100,000 or on an annualized basis during the covered period, and then they cut the salary after?
Yeah, that's what it looks like.
Well, any cuts that are made after you're outside of the covered period don't impact your forgiveness. It's only cuts that happened within the covered period, so either the 8 weeks or the 24 weeks. If a cut happens after that, that's not going to impact your forgiveness.
Okay. Okay. The next question was, if you use up the loan amount at the end of the week, do you have to wait 14 weeks to apply for forgiveness?
Assuming you're on the 8-week covered period, as soon as you have all the documentation ready, I think you should just contact your bank and ask them when they're going to allow you to submit. And I as soon as you have all your application information together, I would submit the application. I don't see any reason to wait.
Okay.
Just so you know, we've been in touch with our bank and they're creating their own form, Citizens is, just like they created their own application process, and that's not available yet, probably because of all of these things that we're
Right.
just talking about. So it's probably a good idea to get in touch with the people who gave you the money to find out when they're going to be the earliest they'll be accepting applications, and do they have the forms ready? Because I think a lot of people are still developing them.
Well, thanks, Ann.
And then it looks like there's just one more here. Can you use the hours, not the pay, for employees using the FFCRA on an intermittent basis for purposes of the tests?
Yeah, that's a great question. So I believe you can, because, and I say that, you know, with again with the big caveat that I should have started the whole presentation with. I believe you can, because you have not reduced their hours. They are voluntarily electing to participate in that. So for purposes of the FTE headcount test and the wage dilution test, I don't think they should negatively impact you in any way, because it's they're voluntarily making that determination. So I think you'll be okay there. You cannot include the cost in the use of the loan money, because you're actually assuming you're applying for the payroll tax credit. You're getting refunded that money through your payroll tax credit, so you can't double dip and use those costs for purposes of expending the money. But I don't think that specific situation would negatively impact the forgiveness calculation.
And I think that was the last one.
So I have just a couple quick ones that I jotted down while we were going through. You were going over rentals, Xerox rentals, postage meter rentals. We think those can be included now?
If it's a piece of personal property, which I would say a postage machine, you know, again, plotter, all those types of things. If you have a lease that was in place before February 15th, and it's a lease, I think you can include those, yes.
Okay, that's awesome. Did we ever talk about maternity leave? Was there any clarification about someone who's out on maternity leave? They're still considered an employee.
So again, I think because that was a voluntary, well, I don't mean to say voluntary, but because that was not a decision that you, the employer, made to reduce their time, I don't think that is going to negatively impact your forgiveness, because that was the employee voluntarily in quotes, choosing to go out on time. So I don't think that is going to negatively impact your forgiveness. That's certainly something that we can look at in more detail, but I don't think that's going to negatively impact you, really, because at the end of the day, the spirit of the law was, if they were trying to prevent employers or give employers incentive and help and aid to not lay people off or reduce their salaries.
Right.
And so that was really putting it as, if you, the employer, choose to do those things, we're going to penalize you from a forgiveness standpoint. But if it's not your choice as the employer, I don't think any of those types of decisions are going to negatively impact the forgiveness.
We do have one more from the chat. It says, what about interest on software lease or purchase? That's a big one for architects and engineers, because a lot of us have long-term agreements for Revit and other software packages.
Yep. So if it's interest on a loan that is secured by real or personal property, it is included. So that's a great question. I believe Paula, I see in the chat. So we can talk about that. I think we may be able to get it in there. That's
good. Well, we've gone a little bit over. Thank you everyone for still hanging in there. If anyone wants to unmute and ask any questions that you didn't put in the chat, now's the time. Still have 13 people with us. That's not bad since we went a little over. All right. If not, I'm going to say thank you all. Thank you so much, Chad, for going through this. I honestly wouldn't know how to do this without you. I really, really appreciate your guidance, and especially since the new things came out, last night. Very current.
No problem at all. Good luck, everybody, and happy to help if you have any specific questions.
Great. Thank you so much.
Okay, thank you. Bye-bye.
Bye, everyone.